Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISEE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isee.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Most importantly, what I want everybody to realize that we are an exchange. We're not a broker, we're not a broker-dealer, and we don't give investment advice. So the examples and our ideas here are for illustrative purposes only. Right? The put-call ratio has been around since the 1970s, and just about every options newsletter that I read today still refers to the put-call ratio. One quoted author said that the put-call ratio is one of the best measures that we have seen, or I'm sorry, one of the best measures we have when we are in oversold, which are too bearish, or overbought, too bullish zones. All right, and I've read this multiple times that the put-call ratio is of value at these extreme levels. All right. In its very simplest form, the put-call ratio is nothing more than a measurement that attempts to determine whether investors are bullish or bearish. The traditional put-call calculation is very simple. It's the overall number of puts divided by the overall number of calls, and you get a ratio, which can be calculated using all the calls and all the puts for the entire market, or the values can be calculated using specific securities or specific sectors, or for instance, many times you'll see a put-call ratio for all equities as well as for the entire market. The ISEE index is a unique calculation that requires proprietary ISEE trade data, where the traditional put-call ratio makes no distinction as to the type of the trade. We only use customer opening long positions for our calculation. All right? We believe that customer trades provide a more accurate representation of true investor sentiment. And for those of you that are not familiar with the different types of trades, and I apologize for some of you that have been here before, this is going to be repetitive, but I think it's important for people to understand that we recognize three types of trades. There's market maker trades, there's firm trades, and there are customer trades. The market maker's job essentially is to provide liquidity. So they tend to be indifferent as to the direction of the underlying security or whether they're bullish or bearish. Firm trades, which will include proprietary trading desks, tend to execute strategies as well as simply put and call buying. So it's difficult to detect whether they are bullish or bearish or whether they may be long or short a particular security. For example, if a major firm comes in and buys 2,000 calls of Yahoo, are they bullish on Yahoo? Well, they might be short 1 million shares and simply hedging 20% of their position. So it's difficult to tell with firm trade as well whether they're truly bullish or truly bearish. So we tend to believe that using customer trades only provides that more accurate representation of true investor sentiment. Keep in mind that the values of the two indicators, the ISEE index versus the traditional put-call ratio, are inverse because the formulas are opposite. So a high put-call value for the ISEE means that there's a lot of put buying for the traditional put-call ratio, and a high ISEE value for the or high ISEE value means that there's a lot of call buying. So they tend to be opposite in terms of looking at the values, but they both tend to be contrarian indicators. And again, both tend to appear most tend to appear to be most useful at extreme levels. Right. This is the again, the update for 2008. We did this through the end of August at the time when we started preparing this paper. We did the comparison for last year of the ISEE index versus the Dow Jones. That is also available on our website. And we originally started posting our ISEE values in 2003 on our website. We know the Dow Jones has been around for much longer than that. Right? There are many different ways to analyze the data. I am not a statistical or quantitative analyst, but I'll give you the method that we use to come up with the data for the comparison purposes. As I said, most people that write about put-call data tend to watch the extreme readings. So, we only want to use the extreme readings. Well, that's somewhat ambiguous, so we had to come up with some method to determine what values we wanted to use. So all we did was simply use an 80-20 rule, and therefore we're guessing, that 80% of the values may be just noise, but 20% of the values may be worth watching. So through the end of August, we had approximately 120 trading days this year. So we simply took, to come up with the 20% of the values, we took the 10% highest values and 10% of the lowest values, which ends up being around the 17 highest values and 17 lowest values for comparison purposes. The highs, there were actually a couple more because the top three values were tied, so we used 19 figures instead of 17 for the highs. Other people that have written about the ISEE, which you'll see that there's stories on our website at isee.com/ISEE, have indicated that the ISEE index tends to give good market direction when there are consecutive days in a row of high or low values. So we're most interested in seeing the consecutive days of the high and low values, or these clusters. And basically, for 2008 so far, we saw a cluster of low values in the March time frame and a cluster of high values basically in April and a couple more in May. And that's what we've seen at this point that we're taking a closer look at right now. Okay, so 3 times in 2008 when we experienced the clusters. Well, we're going to take a closer look at these periods, but let me just go on to the next slide. This is the S&P 500. The last time we did the presentation, we were asked to also present our findings comparing the ISEE to the S&P 500. So again, same methodology. We took the top 17 highest values and top 17 lowest values, and essentially the comparison between the S&P and the Dow is strikingly similar. Again, 3 clusters, lows in March, highs in end of April and beginning of May.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isee.com/podcasts.